spotting market tops, the MVRV Z-score. Now, without getting too technical, the MVRV Z-score basically tells us if Bitcoin is over or undervalued relative to its fair value. When the score enters the red zone, it has historically signaled a market top. As you can see, while Bitcoin is trading near its all-time highs, the MVRV Z-score is nowhere near the levels associated with previous tops. This divergence suggests the current rally may still have significant room to run before it gets overheated. The data is telling us that while the market is optimistic, we are not yet in the state of mass euphoria that defines a true blow-off top. Now, if you want to be ready for what comes next, whether it's a dip to be bought or the next leg up, having a reliable exchange is critical. And that's why you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. Now, to get these goodies, all you need to do is hit the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals won't be around forever, so take advantage of them ASAP while you can, using the link in the description or the QR code. Okay, back to the video. So, with the on-chain data suggesting we are far from the top, let's turn to the big players on Wall Street. What are their price targets and how are they coming up with these numbers? Well, the Wall Street consensus average sits at around $156,000 for year-end of 2025. But some of the biggest names are far more bullish. Standard Chartered has been one of the most aggressive, reaffirming their year-end 2025 price target of $200,000. And their reasoning is simple. The game has changed. They argue that the old, predictable 4-year cycle is being broken by the new regime of ETF flows. And they expect at least another $20 billion in ETF inflows by the end of the year, which they believe will overpower any profit-taking from long-term holders. JP Morgan has a more methodical approach, but arrives at a similarly bullish conclusion. Their analysts estimate Bitcoin could climb to $165,000 based on a volatility-adjusted comparison with gold. Essentially, they calculate how much capital would be needed for Bitcoin's market cap to match the private holdings of gold once you account for risk. Their model suggests Bitcoin is currently undervalued relative to gold. Firms like VanEck and Bitwise echo this sentiment, with targets ranging from $180,000 to over $200,000, all citing continued institutional demand as the primary driver. The key takeaway is that the institutions now driving the market believe there is significant upside ahead. So, if the top isn't now, when could it be? While the old 4-year cycle may be less relevant, historical timing patterns can still offer clues. In previous cycles, the most significant price appreciation happened between 500 and 720 days after the halving. If that pattern were to repeat, it would point to a potential cycle peak sometime between the end of 2025 and the first quarter of 2026. And this timeline aligns surprisingly well with the institutional price targets. Another classic indicator, the Pi cycle top, which has historically been very accurate at calling tops, has not yet crossed, suggesting the final peak is still ahead of us. Now, it's easy to get carried away with all of these great price targets, but here at the Bureau, we like to look at both sides of the coin. So, what could derail this entire rally? Well, the single biggest risk remains macroeconomic. The current rally is supported by expectations of a Federal Reserve rate cut. If inflation data comes in hot and the Fed reverses course or signals a more hawkish stance, it could pull the rug out from risk assets, including Bitcoin. This is a medium probability, high impact risk that every investor needs to watch. The second major risk is leverage. According to CoinGlass, the total open interest in Bitcoin futures has reached a record high of over $88 billion. And this means the derivatives markets is incredibly leveraged right now. Think of it like a skyscraper built on a shaky foundation. While leverage can amplify moves to the upside, it also makes the market extremely vulnerable to cascading liquidations on the way down. A sudden price drop could trigger a domino effect of forced selling, leading to a much deeper correction than fundamentals would suggest. And finally, there are always geopolitical risks. We recently saw how tensions in the Middle East caused a short-term dip as investors fled to traditional safe havens like gold. While Bitcoin has proven resilient, an escalating global conflict could certainly introduce extreme volatility. Happily, the situation in the Middle East has improved dramatically in recent days, but the region and much of the wider world remain troubled. So, how likely are these risks to materialize? Well, a catastrophic 2017-style 80% crash seems to be a low probability event. The sheer scale of institutional inflows from ETFs provides a significant buffer and a base of demand that simply didn't exist in previous cycles. A moderate correction of 15 to 25%, however, is a much higher probability scenario. Given the extreme leverage in the system, a flush out of this magnitude could easily be triggered by some negative macro news or a geopolitical headline. This is something that traders should be prepared for. The most likely scenario, in our view, is a continued volatile uptrend through the end of the year and into early 2026. So, to wrap it all up, the shocking rally to just above $126,000 was driven by an unprecedented wave of institutional capital via spot ETFs, which broke the established pattern of sell-offs at new highs. While short-term technical indicators are flashing signs of caution, the underlying on-chain fundamentals are incredibly strong. The supply on exchanges is at a 6-year low, and crucial indicators like the MVRV score suggest we are far from a euphoric market top. Wall Street is now targeting the $150,000 to $200,000 range, with historical cycle timing pointing towards a potential peak in early 2026. The era of a purely retail-driven 4-year cycle seems to be over. We are in a new paradigm anchored by institutional capital. This doesn't mean it's up only, but it does suggest that the brutal 80% drawdowns of the past era are less likely. The path forward will be volatile, but the data strongly suggests this rally has room to run. Hold on tight. Okay, and if you want to master the art of technical analysis to spot your own entries and exits, then check out a video on that right over here. And if you want to learn our ultimate strategy for long-term crypto investing, then check out the video right over here. Thank you guys very much for watching, and I will see you in the next video. This is Nick, signing off.